The market is focused on quarterly noise. The real question is whether you can read a business the way a board must read it, with consequences attached. Most people study headlines, valuation multiples, and charisma. I look for incentives, cash conversion, balance sheet pressure, and what management was quietly optimizing for. I sat through enough strategy reviews to know that a company rarely dies where the newspapers place the body. The visible wound comes late. The real damage usually starts in a compensation plan, an acquisition model, a refinancing assumption, or a CEO's private definition of success. By the time the story reaches the public, the game is already lost. The mechanism has already done its work. If I were walking into the board meeting on almost any troubled company, I would want one page in front of me. It would show return on invested capital, free cash flow after maintenance, net leverage, stock-based compensation, and customer concentration. 5 lines, plenty of truth. A glossy deck usually arrives to distract from precisely those 5 lines, so let me frame the subject plainly. Business case studies, company autopsies, asset analysis, and CEO performance are usually treated as separate disciplines. In practice, they sit on one operating table. A business model determines the quality of the asset. The asset constrains the CEO. The CEO shapes incentives. Those incentives decide whether the case study becomes a success story or an obituary. I begin with the asset before I look at the executive. A mediocre CEO can still report respectable numbers for a while if the asset throws off cash, has pricing power, and sits in a protected market. A brilliant CEO cannot perform miracles with a structurally poor asset for long. Gravity remains undefeated. It simply submits its report on a delay. Then I ask what management was actually building. Reported growth can come from selling more, buying more, discounting more, extending terms, or counting more generously. Those are very different activities wearing the same costume. In the 1990s, I saw more than one chief executive celebrated for discipline when the company had merely borrowed tomorrow's demand and asked accounting to be polite about it. The board's job, at least in theory, is to separate operating reality from presentation quality. In practice, boards are made of human beings. Human beings enjoy a rising stock price, a confident narrative, and consultants bearing binders. If the capital markets are friendly, supervision gets lazier. If the chief executive is admired, questions arrive softer and later. That has been true in every decade I've worked. Now to the autopsy itself. Most corporate failures are explained publicly as strategy mistakes, macro shocks, or one flamboyant leader going too far. Sometimes that is accurate. More often, the true cause is a stack of small governance decisions that made one bad quarter unrecoverable. Too much leverage, too little operational redundancy, incentives tied to revenue instead of cash, a board hypnotized by adjusted earnings. Take acquisitions. Boards love the word synergy because it allows everyone to project virtue onto arithmetic. I have approved acquisitions that worked and declined many that would have become expensive theater. Enough to fit on a napkin. Are you buying a better asset at a sensible price, or are you paying for the hope that your own organization will become more competent after closing? Capital allocation is where a CEO's character becomes measurable. Press interviews reveal style. Buybacks at inflated valuations, empire-building deals, dividend promises unsupported by cash generation. And underinvestment in maintenance reveals substance. I have watched polished leaders present 10-year visions while starving the systems, plants, and people that made next year's numbers possible. Deferred maintenance is one of management's favorite cosmetic procedures. Another recurring mechanism is timing risk disguised as confidence. A company with short-term debt funding long-lived assets can look clever during calm markets. Then, rates move, lenders retreat, or a covenant starts breathing down management's neck. Suddenly, the debate is no longer strategic. It becomes clerical and urgent. I've seen distinguished chief executives reduced to discussing waiver fees as if they were national policy. Incentives deserve their own page because they explain conduct better than mission statements do. If compensation rewards adjusted EBITDA growth, management will discover a theology of add-backs. If bonuses hinge on unit expansion, stores or sales teams multiply beyond economic logic. If the stock is the scoreboard, buybacks and storytelling become operating tools. People do what pays. This should surprise no one who has ever signed a compensation memo. Then there is CEO performance itself, the most theatrical and least understood variable. I judge a chief executive on 4 things. First, quality of capital allocation. Second, accuracy of self-assessment. Ability to say no to fashionable nonsense. Fourth, whether bad news travels upward quickly. A leader who cannot hear trouble in time is not leading. He is hosting a recital. I have seen this before. In 2001, at Enron, the public story centered on innovation and complexity. The board-level story was more ordinary and more damning. Incentives prized deal volume, mark-to-model earnings, and prestige. Governance tolerated structures that obscured risk transfer. The condition was familiar. A celebrated management team had taught itself to mistake financial engineering for operating performance. A different costume appeared in 2008, with General Electric's dependence on GE Capital. For years, the industrial franchise gave comfort, and the financing arm gave lift. Cheap funding made the blended enterprise look stronger than it was. When liquidity tightened, the market separated the parts with unusual speed. I remember that period well. Conglomerates often promise resilience right up until one division becomes the house banker. In 2015, Valent offered another version of the same pattern. The company was praised for relentless execution, acquisitive discipline, and margin expansion. Underneath sat a model leaning on price increases, deal flow, and adjusted metrics that flattered continuity. Once the acquisition treadmill slowed and scrutiny rose, the economics looked far less durable. Roll-ups can seem elegant until organic reality asks to see the books. You can find a cleaner operational parallel in 2017 at General Electric again, this time under the weight of optimistic assumptions, weak cash conversion, and years of managerial smoothing. Investors had accepted earnings as evidence of strength. Cash said otherwise. I have told directors for decades that cash is harder to flatter over long periods. It has fewer social ambitions than earnings. And if you want the modern boardroom case study in charisma outrunning controls, look at WeWork in 2019. The headlines mocked the founder's behavior, and deservedly so. The structural issue reached further. SoftBank Capital delayed market discipline. Governance accepted conflicts that should have ended meetings early. And the business model lacked the unit economics to support the mythology. Cheap capital can preserve illusions longer than reason can. Across these cases, the pattern is stable. Strong narrative, permissive financing, incentive systems rewarding appearance, and a board slow to reprice reality. Different sectors, same machinery. I used to tell my directors that every era invents fresh jargon for old mistakes. The jargon changes first. The write-down arrives later. Auditors, unlike public relations teams, eventually insist on nouns and numbers. So here is my settled view. A serious business analysis begins with the asset, then traces the incentives, then inspects financing, and only after that, judges the CEO. Charisma will trick you. If free cash flow, maintenance needs, customer economics, and leverage all align, I grow more forgiving. If they do not, I become very difficult company. The final pattern is this. Companies rarely collapse because nobody saw the risk. They collapse because the institution kept rewarding the behavior creating it. That was true in 2001, 2008, 2015, and 2019. It will be true again. Who else is running this same playbook today?